and happy Tuesday, everyone. Welcome to AACUC's Solutions Webinar Series. This is part 3. And today we're going to be discussing leveraging innovation for growth and sustainability. Now, I need you to look to your left and to your right. If you are missing teammates and fellow industry mates, I need you to get on the phone, call them, text them, and tell them that they are late for the greatest webinar series on earth and in this industry on today, and to come on in. So now while you're doing that, we're going to turn this over and have a welcome from our president and visionary, Ms. Renee Sadie-White.
Thank you, Michelle. Hello, everyone, and welcome to the webinar. Oh my gosh. I want to thank Michelle again, our esteemed panelists and our phenomenal AACC audience for joining us again for a topic of great significance to me and the credit union movement, small credit union sustainability. There has been a truly breathtaking pace of innovations in fintech since 2020. It's our hope and our vision here at AACC that these innovations will help to sustain and future-proof the smaller credit unions. Today's webinar is part 3, as Michelle said, of a 4-part series. Our topic today is entitled Leveraging Innovation for Growth and Sustainability. Some of the questions that our panel will explore today will include: how can fintech solutions help credit unions remain competitive against larger financial institutions and neobanks? How innovations can improve the member experience, attract new younger members, and reduce operational costs, and the emerging role of personalized financial services and how AI will drive the personalization to a heightened level. Now, I'd like to introduce our moderator for today, Michelle Outlaw, who I have a girl crush on and have for the last 5 years. She's phenomenal. She is so good. She was my number 2 for about 2 years at ACUC when I came back. She is a woman who has a lot of experience in not just banking, but in credit unions. She's been a CEO of a credit union, two CEO gigs as credit unions. She's done phenomenal work as chief lending officer, and she does a lot of work with small businesses. I just can't thank her enough for bringing her 25 years of experience to ACUC and to be your moderator today. I am certain that Fanta, Ravi, Keith, and Yoel are going to give you insights that you have not even thought about. So Michelle, without further ado, take it away.
Thank you so much. And all right, everybody, let's get into it. We do have a phenomenal panel today. And at this time, I'm going to give each of them 2 to 3 minutes to give us a brief introduction of themselves and their organizations, to discuss their roles in promoting innovations for credit unions, and what are their key offerings that are most applicable to our small credit unions. And so we will start with Ms. Fontagilla. We're going to move into Yoel G. Then we'll have Keith Dunlap, and we'll have Ravi De Silva in that order. So take it away, Fonta.
Thank you. Thank you. Good afternoon, everyone. Again, my name is Fonta Gilliam, and I am the CEO and founder of Wealthy. Wealthy is a financial technology company, and we're really focused on how we can help credit unions really reimagine their mobile banking experience for the next generation. A lot of the technology that I'm going to talk to you about today is really focused on how we can help credit unions really modernize their mobile banking experiences, which is where a lot of the younger generation in particular lives. So let me share my screen. I'm going to walk you through a couple of really short slides that explain our technology and how we're leveraging it to help credit unions expand their membership base to the under 45 demographic. And so first, I want to start off by talking a little bit about, what is this banking Mil-Z phenomenon and who is Mil-Z? We define millennials and Gen Z as Americans aged 25 to 45. They bank much differently than previous generations. Most of us, around 80%, are intentionally going to social networking platforms for financial advice, saving advice, investing advice, not retail bank branches. We're not even talking to our dad's financial advisors to be quite honest. We're going to places like Reddit, YouTube, TikTok for that advice. And we're getting information from people that are not vetted, they're not certified, and they're not trained. Tragically, around 79% of us bank with larger mega banks, not credit unions, who oftentimes have the best products and the services for the life financial goals that a lot of us have. We're also facing a situation where America's undergoing a $68 trillion wealth transfer as baby boomers transfer their wealth to their children and their grandchildren. This generation is desperate for financial advice. And we're excited about a solution that Wealthy offers that can really help bridge that gap between the credit unions and the great impact and services that you offer and this younger generation and customers. And so what Wealthy provides is an AI embedded mobile branch and digital wallet. It's designed for credit unions to white label with your brand. You can customize it for your target segment, whether it's consumer, small business, or wealth. And it's designed to insert inside your existing mobile banking applications. We have opportunities with no integration required. And what makes our branch different, and I'm excited to deep dive this with you further in Q&A, but what we're doing is leveraging the power of social networking, AI-powered banking products and services, and embedded financial experts at credit unions to improve that member experience, help you essentially attract and retain younger customers, and cross-sell products and services. So I'll stop there, and I'm really looking forward to the Q&A and chatting more about Wealthy's technology and how we can help you make Meal Z. Thank you.
Yoel?
Awesome. And thank you so much for that presentation. Amazing. So, hi, everybody. I'm Joel, founder and CEO of Quash.ai. Quash is an artificial intelligence platform for financial institutions, to especially credit unions, to increase credit origination to their underserved but credit-worthy borrowers using AI and alternative data, all compliant with CCPA, Financial Credit Reporting Act, and Financial Credit Bureau as well standards. I'm going to show you, basically, we have three solutions. The first solution is a very simple inclusion score that basically uses digital identity. We also have other alternative data sources like employment data, utility data, open banking, and many more. But this case particularly is an inclusion score that with more than 70% accuracy, it's capable of separating between who's going to be a good or bad borrower in terms of financial inclusion. So this is a whole different way to evaluate individuals that are either immigrants or thin file, no file or thin file borrowers, or they don't have credit history in the credit bureaus, or they simply failed, and this is a second opportunity for them. So basically, by just using email, phone, age, gender, and marital status, it enriches with more than 120 variables. And you might be asking, what's the correlation between digital identity and a borrower's capacity to pay a loan? Well, just one example, your e-commerce, the e-commerce sites you visit reveal spending habits or financial behavior, or the type of phone or the subscriptions premium services that you have are related to high economic status. So basically, if you use this without connecting it with the credit bureau, you have more than 70% predictability of who's going to be a good or bad borrower. And this doesn't even require you as a credit union to send your internal information. Well, once you send your internal information, this goes up to 10 points, like 80 something, because it has been proven that the internal information or behavioral data that you have represents more than 80% of the predictability. So you can start with just, the inclusion score, which will take you in a very simple way in less than 2 weeks, all the way to accuracy. But once you believe in this, and then you want to, pre-process, categorize, contextualize in high-dimensional spaces with nonlinear models your internal data, then you go up to more than 80% discrimination capacity. And so this is the first product. The second product basically is a platform, and this is how you get to 80%. Basically, this AI decisioning platform here, you can build, you can create programs, you can and pre-process, categorize, contextualize your information. You can enrich with alternative data sources. Then you can determine what data it's giving errors or adding a huge value. And then you can start orchestrating enriched predictions across decision trees, decision flows. So this is like the ideal dream of a credit risk director, because it combines the three worlds of alternative data, decisioning capacities, and predict anything you want: pre-qualify, measure payment capacity, infer income, what amount, what interest rate to give, when to increase a credit line, and so on. And this is all orchestrated between your decisioning trees, rules, flows, and so on. So at some points you have your rules, but sometimes you need to invoke predictions as well. And finally, we are in the ChatGPT era. So we're moving away from SaaS services to actually agents. And Quash is an AI agent, has the most sophisticated product of us. It's an AI agent where basically before, when we were using humans doing the process of building machine learning models, it took a lot of more time and a lot of more resources. So we have now found ways to actually use generative AI, foundational models, large language models with today's, OpenAI and Grok and all of these new technologies that are super trending right now. And now we have a way for credit unions to implement this technology as well.
Thank you, Yoel. Keith?
Yes. So I'm Keith Dunlap, happy to be with you all this afternoon from TrueStage. So you all are very familiar with TrueStage on the investment and insurance side of the business. I work with the ventures team, and on TrueStage Ventures, we invest in early stage technology companies to bring new technology and software to credit unions and their members. Our whole goal is to support the credit union movement. And today we want to talk about how TrueStage is involved in the technology space, and also how we support credit unions and members of all sizes.
Wonderful. Thank you so much.
Mm-hmm. So really quick, just wanted to share a slide with the team. Is the reason that fintech is very important and that we should all on this call take it very serious is because all the credit unions on this call have the member. That is the most important business achievement you have, a membership base. However, members have a lot of options. If you don't give them the options that they want to interact with your credit union and become more efficient at your credit union so you can support the members at every need that they have for savings and borrowing, they will go somewhere else. And so that's why TrueStage Ventures is investing in technology to bring to the industry, because we need to think about digital transformation differently. Credit unions may be at the Palm Pilot stage or the BlackBerry stage, but we all need to get all credit unions to the iPhone or the new technology, because all members of all ages and all size credit unions are used to dealing with institutions that deal directly with them on the mediums they want. And look forward to sharing more in the Q&A. Thank you.
Thank you. Ravi? Ravi, you're on mute.
There you go. Second try. Good afternoon, everyone. My name is Ravi De Silva, CEO of D-Risk Partners. We are a compliance consulting firm launched by former Citigroup compliance executives and former US regulators. We serve credit unions of all sizes. So I don't have a presentation, but I did take some notes from my other panelists who just introduced their organizations. And I know if you're a credit union CCO or a CEO or a CRO, you would have had the same questions go through when the presentations happened. So Quash AI, great technology, but as a compliance person and as a credit union, your first thought is, what about fair lending? Is this AI agent, does it have biases, et cetera? Right? I'm not saying it is, but I'm saying these are the things that goes through, right? I'm looking at it from a compliance perspective. Wealthy AI, a fantastic technology. Again, with the digital wallets, AML, sanctions, do we have the framework within the credit union to support this? And then TrueStage Ventures, right? You talked about going from platform to platform, moving from Palm to iPhone. Again, there's things that we need to think about to protect our members, cybersecurity, data loss, etc. Right? So these are the areas that we think about, and we help you to think about and be compliant with regulations in the US, right, related to credit unions. We have a great product that we're launching, specially aimed at the small credit unions. It's a fractional CCO service that includes the technology, regulatory technology, and it's affordable. And this is, I'm happy to talk about this more later on offline. It's offered at $2,850 a month at a retainer for the first 12 months. And we're launching this today, and we are going into the NACUSA conference, which we're going to be there launching as well. So thank you very much for having this. This is fantastic panel, and I'm looking forward to the rest of the conversation.
Thank you so much, Ravi. And out to our guests, if you have any questions while we're going along in the presentation today, please feel free to place those questions in the chat. If we can get to those questions at the end of the webinar before 2 o'clock, we will answer those questions. And if not, we will follow up. So panel, everyone's talked about these solutions. What do you believe are some of the emerging technologies that credit unions should adopt in the next 3 to 5 years to drive growth? We'll start with Fonda.
Sure, I can kick that off. You know, I think that one thing that all financial institutions are looking at is how can they increase member acquisition, retention, top of funnel, right? A lot of the technologies right now are looking at back-end solutions to service members, but how do you actually bring them into the door, especially if they're not walking into your retail branches? And so what we're seeing right now, as I mentioned earlier, is a huge trend around how you can leverage things like social networking and social media as a way to do that. AI-driven tools that create a very hyper-personalized experience for your members that feels like a private banking experience at scale. This is the trend that we see the industry going in, especially if you're looking to service these younger customers that expect it to be mobile first, expect it to be on autopilot, and don't want to think much or have to even really talk to someone to get that private banking experience. And so I highly encourage credit unions to lean in on that type of innovation, embrace social networking in the same way that they do community, which is how credit unions were founded. I see that as definitely the future, and looking at AI as a way to really personalize member experiences as much as possible.
Yeah, 100% with Fanta. I think that talking about this younger population, which we heard at the GAC in Washington 2 weeks ago, that the demography is destiny. This young population or demography, what they're basically experiencing outside the credit union is interacting with Netflix, with Spotify, with Amazon. So what does that have to do with credit unions, and how can we change the experience at the credit union that is at the level of the other things that they use? For example, Spotify beat Pandora because it's more likely the next song will sound better in Spotify than Pandora. Netflix knows what movie you're going to watch next, Amazon what product. So that in the credit union world, that's called hyper-personalizing the credit experience, which is building financial products in real time and assigning an interest rate according to the risk of each individual. So how do you do that? And basically, maybe we can dive in a little bit later and continue this conversation. But one of the points that I think we can go in is how do you start? Because you could start from the front of Wealthy, or you could start by just saying, hey, do you have still that same 40-year-old mentality on of actuarial vision of just having rigid rules and policies, or did you already added machine learning to separate better who's going to be a good or bad borrower? Oh, if you already have that maximized, then you can move to the next layer, which could be, okay, how many prediction I could have. And that takes you, once you dive in the road, to hyper personalizing the experience. But we can dive in later on in the conversation about that.
Yeah, so at True Stage Ventures, we have the easy job. We are here to support founders of technologies and also support credit unions that support their members. So you all at the credit union that support your members every day, run the credit union, have the hard job. The folks on the panel, building technology is very hard. It's not an easy thing to do in building companies. I would say to answer the question, Michelle, is that credit unions have to understand today that they are being compared to DoorDash. They're not being compared to another credit union or bank. I, as a consumer or member, expect everyone to be on the same level as Netflix, Spotify, Uber Eats. It's no difference. So what that means is that credit unions need to adopt technology faster and quicker and get more efficient in the back office, because their individual members, when you're trying to gain wallet share or gain new members, are going to expect you to be on par with everyone else day one. We have whole generations of people who have not grown up with anything except for a smartphone in their hand, and they're encouraging their older family members and older people in their lives to use the same technology. So the fastest growing group on social media is people over 50. So it's from 18 to 80, is no one's going to be missed out. So I think adopting tools like artificial intelligence and other software applications will be the most important thing credit unions can do in the next 5 years to position themselves.
Yeah, I totally agree with all my panelists here, and I think there's some good insights there in terms of growth. But when you look at, I mean, I speak to a lot of neobanks and small credit unions, CEOs, and our advisory board, Becky Reed, who used to be a CEO of a Texas-based bank, there's only limited resources that these credit unions have that then need to be invested in supporting the members in AI and in all the other stuff that the panelists talked about. One of the areas that we found, I spoke 2 weeks ago at the fintech meetup, and my panel was all banks under $1 billion and their CEOs. And the topic was compliance or collapse. Right? We can adapt all of these AI technologies, all these other technologies, but if you don't have the infrastructure, back-end infrastructure, that's not going to go anywhere, right? So everyone thinks about compliance as a cost center, but change the perspective slightly, right? I'm talking about growth here without doing too much and trying to identify limited resources to redirect towards growth, right? So the fractional CCO service that we are offering, that is less than $35,000 a year, right? Where are you going to find a CCO for that price, or a CCO function for that price, which includes regulatory technology? Now, that saving itself can be redirected to your growth purposes to support the membership, right? While you have peace of mind that your compliance is also on par with all the advances that are happening. We work with a lot of fintechs that are supporting credit unions, and we collaborate with those fintechs. And we support their compliance so that when they take that product to the credit unions and try to sell it, the CCOs and the CROs and the CEOs of these small credit unions, first question they ask is, what do the regulators think about this? How is my AML program going to be okay with this? And I go to pitches with my fintech clients, and we talk about, hey, this is how regulatory compliant this technology is. We support that AML as well. Here's what we can do for you. Have a look at it. So there's resources that you can redirect today to support AI and other technological advancements in your organization, only if you sort of reorganize and start rethinking about key pillars like compliance.
Great. Thank you all so much. I want to take a deeper dive right now, because everyone spoke about AI. And we understand that this is about leveraging innovation. But I want to talk about now, how can AI and automation improve member services while maintaining a personal touch? And I want to dive into the fact that we talked about the younger generations who love a phone, and all this technology. But we also understand the demographics of our credit unions typically having a more mature age to us. And we may not be as comfortable with this AI and automation, right? So how do we make sure that as we're implementing these technologies, that we're maintaining that personal touch and making sure that the full expansion of the credit union's members are taken care of?
I can take that one again. Sure,
Okay.
sure. And I know Yoel's probably, I see him unmuting as well, so I'm sure he's going to have some insights. So I think that's a really great question. And I think you do have to balance too. And I think that the best fintech solutions are those that integrate both. For example, as Keith mentioned, we know that the over 50 generation is using social networking. If you go to Facebook, for example, they're the largest target segment. They didn't start there. If one of the reasons why a lot of older Americans decided to use Facebook is because they wanted to follow their kids and see what their kids and their grandkids were doing, right? And it turned into a trend that they now use. Now, on the other hand, I can hear my mother in the back of my head saying, I'm not going to use AI. What are you talking about? And so that's why I think that you need to have solutions that embed both. So at Wealthy, one of the things that we do is work with credit unions, not just to automate all of your products and services. We're not looking to replace your retail branch. You need those, right? Obviously, you're going to need a physical presence. So what we do is work with what you have. In addition to having those tellers and those branch managers in that brick and mortar, we also find creative ways to embed them in the virtual experience so that you can request a call or an invitation directly through your virtual branch and actually talk to someone at the credit union, right? And that goes for younger generations too. Credit Karma came out with a report that says that around 40% of younger millennials and Gen Z have actually been hoodwinked, according to the article, by fake influencers online and gotten in trouble with the IRS, gotten into financial trouble because they followed bad advice. And so we respect that too. And we built in ways for you to not only use the virtual AI benefits, but when you need to talk to a human that you can trust, we have features that accommodate that as well. So I feel as if you need a balance between the two. You don't want to get rid of that traditional credit union's support that comes with having that personal relationship, but you also need to be able to, when it's time, bring in that AI and bring folks along with it. And a balance is really how you get there.
Yeah, I can continue that, but yeah, basically we have all heard more than 20 years about digital transformation, right? So digital transformation was a project across the world, not only in the US, that basically enabled, go from all retail branches to have a digital experience. Then when some credit union focuses or 10% of it, or prioritize a project not only on digital transformation, but taking it all the way to AI, they basically always focus on the goal, in the objective. Like, first of all, identifying like the main revenue streams that they have in terms of an economic decision perspective, but also from what type of audience they have. Are they all tech savvy, as Fonda was saying, like, or it's 50-50, or so if not all credit unions the perfect solution will be a balance between the two worlds, because some younger generation, if you are a credit union only focused in the younger population, they will want to go like the neobanks thing, which is like, all the way to the 100% digital, right? Or if you're targeting the elderly, they want not only a touch point to helping them apply, but also on the collection side of it or whatever. But it will all depend. And then on the AI perspective, just to finish, if there's a huge component in terms of education, because the people that generalize the word AI could be sometimes scary or sci-fi, right? If AI is applied in a way that it's helping them achieve more, and at the same time the credit union can reduce huge costs to be more productive, then it's going to be a win-win situation.
I think I'd like to add to that, Michelle, is that when you think about AI is a huge thing. It's a big bubble. And so the first thing I encourage all the credit leaders on the phone is to think about AI as something you get started early and keep going. So you walk into it to get to run into it. And the reason you want to do that is because members, current members and potential members, assume you're already doing it. So when they already give you one piece of information, they assume you know everything about you. So for example, Fanta, Yoel, and Robbie and I, if we just give a credit union our driver's license number or our cell phone number, that's more than enough information you need to process any consumer product. Not so much for mortgage, you need more, and of course for wealth management, you need more as well. However, on the consumer side, just those one or two pieces of information can get you everything you need to process a consumer transaction. So what that means from AI and members, young members and old members, is that the credit union probably should change their process. And what I mean by change their process, use the technology to free up your team to be in person with members who want to be in person and be in your community and be at the places physically that you need to be at and not at your desk processing transaction. Let the software process the transaction, let the AI do the work behind the scenes, and you interact with people. And I think that's how credit unions can leverage AI and also make it personal, because everyone's assuming once they give you their driver's license, you don't need any other information from them. You should be able to figure the rest out yourself, because all of this data is out there, and whether we know how to grab it or not, they're not thinking that we don't. They just assume that we do.
Yeah. So, Michelle, while everyone was talking, I was thinking about how to personalize compliance. But while I was thinking about that, I mean, Welty talked about front-end AI solutions where Welty and I think Quash too, where you can grab information like KYC on a more interactive basis, right, on your phone and etc. And from a compliance perspective, that's what I see as you know, compliance getting more personalized. But from a process automation, AI perspective, the reason that we are able to offer such a cool fractional CCO service at a affordable price is automation and AI. It is overseen by pretty senior U.S. regulators and former compliance executives, but there's technology behind it that supports this kind of fractional CCO services. So just wanted to plug that in there, since I'm the only guy with no presentation, so I'm trying to hook onto you guys. And
I'm actually super interested, Ravi, in your product, and I'm gonna put the hat of my most advanced credit unions to ask you a question and tell you like where they are in terms of compliance with AI before moving out to a different subject, so that maybe you can push the bar and help us understand how far we can get from where we are. So let me just put it in a very simple words, okay? So from a GDPR and CCPA, which is the California Consumer Privacy Act, that they were born around 15 or 20 years, they basically established two figures. Either you're a data processor or a data collector, okay? Data collectors are either credit bureaus, data providers, or credit unions, because they process PII, which is personal identifiable information. Companies like Quash are only allowed to process anonymized information, which is, you know, you use like an anonymous ID. We don't know anything related to who that person is in terms of doing reverse engineering to actually know the end borrower. Okay, so the data, when you do enrichments, goes directly to the data providers, who are data collectors, not data processors. And when they enter Quash, for example, to machine learning algorithms, it's just tied to an anonymous ID. We never get like the email, the phone, and the email. So that's like one component of it. And the other two components are the explainability part, and then the data warehousing. So I'm going to jump on the data warehousing. In the data warehousing, normally you can't mix data from financial institutions. If you are going to be like a credit brain, like your own data should be siloed in your own repository. It's not that you can, the word of, hey, can you please do it on premise? Like that's not, you know, modern enough. You should be able to leverage cloud technology to actually have your own repository and trust as a credit union that you should believe in companies like AWS or Google Cloud or Microsoft Azure to host your information that's yours, that you enable data processing companies like Quash to access it, and you're going to feel safe and confident that that's going to be your only information, even if it's in the cloud. And third and lastly, and I'm going to actually show like the platform per se on the explainability part. When you access a platform, okay, like this in terms of credit risk, financial institutions can either open through a web service or via batch, or they can consume when they're building they're processing, throughout a decision or a credit prediction to decide whether you're going to give out a loan or not. As you can see, you don't know the name. This is obviously dummy data. This is applicant ID, dummy data. You get age, gender, okay, but it was approved or rejected. And what was the score that you actually gave, and what was the data and the models that were used. Now, what regulators love is that you can actually do explainability, where this is not a black box, this is a white box. So you can actually see the weights in which each variable impacted the model of the decision. So and here's where I finish. So when the regulator comes and say, why you gave as a credit union 3,000 loans, they say, and they failed, right? For example, God forbid, but they will want you to send them a report, okay? Because in the US, the compliance cost, as you know more than us, it's higher than the delinquency cost in a lot of instances. So basically, you should be capable to report to the compliance entity what data was used, what model was used, what were the weights of the models, okay? And for example, you can add filters. In some states, they say, okay, for woman, ethnicity, or race, you can only use the Bayesian model, or you cannot discriminate women, all the Fair Credit Reporting Act regulations. So you can actually add them into the filter. So that's how far I get. Now take us farther than that so that we can learn a little bit in terms of compliance.
So I mean, I was listening to what you were saying, the three things, right? So it sounds like you guys have taken the right precautions, but on the last point that you talked about, right? So regulators do look for explainability, and also in situations like lending, one of the favorite things is the fair lending part, right? And how did your algorithm get trained? What is the data that was used to train that algorithm? Does that carry biases, right? So that's the part that, you have a great algorithm, that's great, but also from the data perspective, what was the actual data put in to train that algorithm? That might be a question that you might be asked to respond to.
Yeah, and
Yeah,
I'll go ahead, Fonte, sorry.
No, I was just going to say that's great. I think other kind of things you want to ask as you're looking at potential AI partners and solutions is, what LLMs are they using? Large language models. Who's the vendor? I mean, you can go after DeepSeek if that's something you want to do, run by the Chinese, or you might want to lead into something that's a little more, OpenAI or watsonx with IBM, right? Other questions you might want to ask is, how is, like you mentioned before, are your prompts and are those algorithms designed compliance first, right? Did they design it with compliance in mind? Those are questions that you want to ask. Anonymized data that we talked about, but also how are they embedding that human oversight? We all know that these AI algorithms can give false positives, that can hallucinate. Is there a human touch to it? And then lastly, consumer feedback. Are there tools built in that can assess accuracy, relevancy driven by your members? They're some of the best ones to analyze whether this AI was providing something helpful or not. So those are some of the things I recommend you ask when you're looking at vendors, in addition to hiring kind of oversight, support, and it's things that we've been really thoughtful about as we design our tools.
Fantastic.
And I think that's great, because we all understand in credit union land that compliance is key, and we must answer to the regulators. So before we place something into production, we need to make sure we have our policies, we have our procedures, we are abiding by the regulations, and that we have that compliance in place. So thank you for that great discussion. So next we're going to move to How can you share examples of how fintech partnerships have helped credit unions scale their services effectively? And so that's really piggybacking off of what we've just been discussing. But how has it helped the credit unions scale their services effectively?
Since I guess we're ladies first today, I can jump in. Oh no, I'm going to let you go first.
All right. I was going to say, I think I used this example before. We work with a lot of fintechs who work with credit unions, and we've seen some of these fintechs who provide payment processing services, right? And from my perspective, from a compliance perspective, there's a lot of great fintechs out there that has great products that can be used by all sorts of credit unions. And to Fonta and Joel's point, it's the affordability plus the impact to the existing infrastructure of those small credit unions that matter a lot. So when I say we, as a compliance officer of the fintech, we go to pitch to our credit unions. They do the product pitch, I do the compliance pitch. And then we also, most of the time, what happens is the credit unions turn around and go, hey, that sounds right. So we don't have the right AML infrastructure for this payment processing because this is a high risk AML product. Could you guys come in, build the framework for us? Right. So we've engaged in those instances. So those are, I don't want to name names, but those are the examples that we've seen.
Yeah. Michelle, real quick for TrueStage Ventures. So all the credit unions are collaborators. They're not competitors. So all credit unions should be working together. They should not reinvent the wheel. They should be working on compliance and technology together, so they don't have to do the heavy lift by themselves. They should lean on trusted partners like TrueStage and others to work on this stuff. So the biggest way for TrueStage Ventures standpoint for credit union to see the ROI that they're looking for, and I know this is unpopular, credit unions have to change their process. So if you're taking a paper application that's 3 pages and you need ID and someone to fax in or call in or mail in something, and you buy software, you're never going to see the return on that investment in software until you change the process. And the process today is, like we talked about before, is knowing your customer, your consumer, your member better, knowing more things about them, and also giving them the products and services they want as quickly as possible. And that may be full wallet share or partial. And you have to use the technology as built intended, and can't change the technology to your process. So when you adopt new technology, change your process to fit the new technology, and then credit unions will see the return on their investment, and they'll see that their back office staff will become more efficient. They'll be able to process things faster and also help more members and help each other. And then the members will see when they interact with their credit union that their credit union is state-of-the-art and advanced in technology and not being left behind.
Yeah, amazing. I want to add one comment there that combines a little bit what Ravi and Keith what we're saying. Like events are a very good window to understand what's happening out there, right? But once you have an idea, assess your resources for the goal you have in mind. Maybe you can buy it. You simply can't buy it if something is that customized. No, and I definitely, once you understand the goal and the partner that you would engage, I definitely encourage you to follow the SOW or the statement of work modality, which enables you to achieve set expectations in terms of what's the most ambitious but realistic plan that you could achieve. So do not engage with a partner. My main message would be do not engage with a partner that it's not capable of putting in the whole roadmap of the plan, that if it's something very complex. Maybe some providers have that's why we have the inclusion score, because if you don't have that budget to build like that level of customized plan, you can just simply buy simple products. Like, for example, Ravi said, I have this, like what in the industry enables you with $30 or something $1,000 to just be a little bit more compliant, right? So most of these providers have these type of products, but not necessarily will be like the long-term ideal scenario. So try to find out if you are, for that specific goal, ready in terms of resources and personnel to implement. But once you're ready, make sure to have a statement of work that details as much as possible what are you going to be getting and expecting per month, and the commitments and responsibility you have on your end, because sometimes you'll have a good partner, but because you didn't have the resources on your side, the project will not go as ideally.
Yeah. And the last thing I'll say is, we try to make it as easy as possible to collaborate, not by reinventing the wheel with partners you might not be working with and have to figure out how to vet and de-risk. We're actually working with partners that you're already working with, such as the card networks. We have a really exciting partnership that's hugely beneficial to credit unions, I think, with MasterCard, believe it or not. What we found is that there's a huge growing group of millennials and Gen Z that are looking for small business banking partnerships, right? They're not getting the type of TLC or the access to capital that they might need from some of the larger financial institutions and community banks. A lot of them aren't aware of credit unions. So we're actually putting up mechanisms whereby you can partner with folks like MasterCard and Visa to launch to seed or grow small business banking portfolios, which is something that is in high demand right now. And so in doing that, partnering with existing card networks that you're already working with through your card program, we've designed really innovative ways. And I'll bring up one here that we're doing with MasterCard that's designed to help you leverage your existing procurement vehicles with these card networks, your existing card program agreements, for example, to add features like Wealthy, which make it much easier to subcontract with someone like me without having to do a lot of additional procurement, leveraging your partnerships with card networks to launch new business lines. And so here's a program we're excited about. We're already working with a program, a credit union in Delaware and other financial institutions. And we're excited to expand this out to AACUC members. But this is focused on Business Builder program, where you can use Wealthy as a business virtual branch, leverage MasterCard payment solutions, such as credit card programs that are bespoke and white label, and integrate them into what you're already doing to really expand your membership offerings in a way that helps you attract and retain those members. So this is a great example of how you can use existing partnerships with proven, trusted bodies to really help you hit your growth metrics.
Great, thank you so much. So, and I appreciate that. So now let's talk about and turn our lens to the sustainability and the long-term impact. So how can the fintechs help credit unions build more financially inclusive communities? And I understand how you said we work together, but how do they become financially exclusive communities?
I can take this one first. So I'm gonna get on my soapbox for 15 seconds, so I don't want to take up too much time. Credit unions are on the front lines of people in the community. They're the most localized financial institutions we have. Even though neobanks and new banks are in our pocket because they're on our digital devices, people physically can see the credit union when they drive down the street. Just like they can see the check cash in place, and they can also see all the other payday lenders and all the other predatory institutions in their communities. So I would suggest to credit unions leaders on this call and their teams that at some point, every person is going to be impacted. If you get sick in America or lose your job in America, it's going to be very difficult to maintain a great credit score and also maintain your financial standing where you have today. So the software tools that we invest in, and like the ones on the panel today, allow you to move up and down the credit spectrum. A 600 and a 700 are not totally good or totally bad. A 700 on its way down to a 500 is not great. But a 590 on its way up to a 640 is fantastic. Also, if you're supporting them in their community at their time of need. So I think the way that credit unions typically look at FICO scores and look at risk and also look at compliance need to be re-examined because you have more access to information. So like the traditional FICO scores are very limited, but when you add AI tools and other tools on top of a FICO score, that score is more robust and it tells a bigger picture of credit union and community members that may need your help. And I think credit unions on the front lines to be able to offer that service. You should be able to go out, reach out to people before they have a major problem, go ask people what they need, and also be able to do it in a mobile way. Because if I'm having challenges, I may not be able to come in, fax in, or call in, but I still need those services. So I think to answer your question, Michelle, and I'll hand it over to the panel, is that credit unions are perfectly positioned if they use the tools available, because they're great at great credit scores. They can take that same muscle that they built over 30, 40, 50 years and apply it to all credit scores. So as a person moves through their life and need additional help or they follow hard times, you have enough data today using technology to make a secure decision about offering products and services to anyone at any point in their financial life.
I totally agree. God, Keith, that's powerful. You're exactly right. And I would say financial literacy is another huge piece of it. We have to meet people where they are. Americans writ large, I don't care how old you are, we like snackable social networking content. We don't want to read an article. We don't want to go to a webinar. We don't want to attend a tutorial. I don't want to have a meeting with you about my credit score. And so I'm excited about how more and more financial institutions are leaning into talking to people in their preferred method, right? In a way that they can understand, that's hyper personalized. And so being able to take that community, that personal touch that credit unions can provide, and coupling it with best in class, a little more innovative financial literacy that maybe doesn't even feel like financial literacy, which is what they're getting from influencers. I think those two will really be an incredible solution for the communities that we're trying to support, and something that people can actually adopt.
Yeah. So to combine a little bit my perspective on what Keith and Fonta said, let's use that very simple technique, clustering, correlations, right? If Fonta is a woman married with more than one child that makes more than X amount of dollars, right? And she doesn't have credit history, okay? But there are 326 women that are married, that with the same characteristics, right? Employed with more than one child, et cetera, we could use clustering and correlation technique, right? So that if they didn't have credit history, but for some reason, the credit union gave them a loan, for some reason, they paid on time, we're going to use that correlation as a best proxy to approve fund. That's one, right? So when Keith was saying, like, by leveraging the credit bureau score, it's 100% aligned with this. But remember that when you apply clustering and correlations, and at the beginning that more than 80% of the predictability comes from the internal data of the credit union that somebody had to refine, reprocess, categorize, and contextualize, that's a huge value. It's like the biggest asset in your balance sheet that, because you didn't give the liquidity of it, it's not part of your balance sheet. But your crude data, your raw data, think about Rockefeller in the 1900s, getting the crude and refining it into oil and gas. You have that crude, that raw material inside your credit union. The only thing you need to do is to refine it. Use clustering techniques, use correlations, do enrichments. And what's going to happen is that you're going to have a lot of borrowers. Let's say that you have 9,000 borrowers that has a probability of default of 3.6%. And this is not credit bureaus external. These actually are your credit campaigns. These are your clusters that you own after preprocessing your information. But what happens if you have 21,000 that the probability of default was 6.99? What do you need to do to find out which 10,000 out of these 21 actually are credit-worthy, but underserved but credit-worthy individuals? You could do more predictions. You could do with more alternative data enrichments to bring this 6.99 down to not necessarily 3.6, but whatever the confidence or the risk appetite of your credit union. And that's how you're going to achieve a more inclusive path.
Ravi, would you like to add? Okay.
Yeah.
Well, this is what I'm sorry.
No, I totally agree with everyone. I don't have anything to add on this from my perspective.
Okay, well, great. Well, we are at 1:55, so we're going to have a lightning rod presentation. So 30 to 60 seconds each panelist. give us a strategy that your organization can help credit unions in the next 3 to 5 years to build this innovation and sustainability.
I'll go first, 15 seconds, I promise, Michelle. Please reach out to your TrueStage rep to get in contact if you have any questions about technology, adopting technologies, want to demo anything. We at the TrueStage Ventures team is here to support credit unions and their members with investing in technology. So we're happy and we are charged to help credit unions meet you where you're at. And I will advise the credit unions on the call, you can't wait on technology. Please change your process to the new technology you have. Please work together and please move as quickly as you can, because it's not like adopting an LOS or a core. It's not an every 10-year. We're way past that stage. Technology will change more in the next 5 years than it's changed in the last 50 years.
Thank you.
I'll go next. Let's sit down and co-create a strategy to win younger members, millennials and Gen Z. We can partner with you through your card network, whether it's MasterCard or Visa. Wealthy's demonstrating a 56% higher lead generation rate than industry competitors. And I think it's because we're hitting into a common pain point and trend that a lot of these younger members and potential members want to see. I'd love to sit down and do that with you.
Yeah, let me go next. So we're de-risk partners. We'll be there next week as well. I think what we should do is we should sit down, figure out what you have today. These are great products that you have in the market today. And I think to grow as a small credit union, you do need the technology, you do need the innovation. To do that, let's redirect the resources adequately, right? You're spending a lot of money, a lot of questions on compliance. Let's take advantage of things like the fractional CCO services that we are providing, right? The first 20 clients, we have highly discounted rates. Let's try it out. These are all not contracts. These are month-on-month services. Try it out and see how you can build your compliance infrastructure to support the AI, the technology that my other panelists talked about, and how to redirect your resources, save money on the compliance, and invest that in the growth of your credit union.
Yeah, fine. Yeah, finally, Mir. I was trying to share my information to everyone here, everyone in the meeting. Okay. Yeah, so basically, very quickly, first of all, find out if you want to do a simple project or a sophisticated long-term project. We have both alternatives. If you want to engage in the more sophisticated long-term strategy, the first question you need to ask is, are you currently using machine learning? Like, do you, in your credit risk department, go today and ask your credit risk director, are you using Gini, KS, AUC, Boxflow, vintage analysis, performance inference analysis, intrinsic values, population stability index? These are like the language of credit in today's world. They all go between 0 and 1, closer to 1, higher discrimination capacity of who's going to be a good or bad borrower. So that's the starting point. Like from there, you can have many predictions, a lot of AI, Gen AI, hyper-personalization, a more inclusive, like all of that. Preprocessing your data, having data quality and good model development are the basis and the foundation for having the privilege to leverage all the technologies, not only Gen AI, but everything that will become much faster speed in the next years. I'll be next week in Atlanta. I'll be in all the events that we have, inclusive Nacuso, Las Vegas, Cleveland, everywhere that the credit union space, we're there. So happy to meet everybody.
Well, thank you all so much. This has been an invigorating conversation. And so I hope that each and every person took something from it. Panelists, thank you so much. Audience, thank you so much. Come back on Thursday for part 4 on Let's Reimagine Our Small and Mighty Credit Unions. Have a great day, everyone.